Good morning. Welcome to the Heritage Foundation and our Lewis Lehrman Auditorium. We, of course, welcome those who join us on all of these occasions on our heritage.org website. Would ask everyone here in-house if you'll make that last courtesy check that your cell phones have been turned off. It will be appreciated. And, of course, our Internet viewers are always welcome to send their questions or comments, simply emailing us at speaker@heritage.org. We will post the program within 24 hours on the Heritage homepage for everyone's future reference as well. Hosting our discussion today is Laura Truman, Director of Strategic Operations. She focuses on three core policy areas for Heritage: improving health care, reforming entitlement spending, and preserving families and religious freedom. She was a legislative assistant to former Senator Dan Nichols and served in his service on the Health, Education, Labor, and Pensions Committee. She worked on Social Security amendments in 1983, the 1984 Baby Doe Law, and was instrumental in passage of Adolescent Family Life Program. In 1986, she was appointed to the Department of Health and Human Services by President Reagan. She later continued her public policy career as Executive Director of the Coalition for Affordable Health Coverage. And immediately prior to joining us here at Heritage, she served with AmeriChoice, a subsidiary of United Health Group, to work for state-based health reform and Medicaid managed care. Please join me in welcoming Laura Truman. Laura?
Great. Welcome to the Heritage Foundation. Now we are 2 weeks into the rollout of the Affordable Health Care Act and the opening of the exchanges. Delays, technical problems, security concerns, and enormous consumer frustration have plagued the start. But there is one key question which gets at the heart of the purpose of Obamacare that needs to be answered, and that is the Affordable Care Act making health insurance more affordable? This morning you will hear answers to that question from three different perspectives. First, we'll get new numbers. Drew Goncharowski, a policy analyst with the Heritage's Center for Data Analysis, has a master's degree in economics and maintains the very sophisticated and robust databases that the center uses for modeling both predictive and analytical work. Drew's research focus is on the new health care law, and today he's going to be presenting findings on the change in premiums. He's going to look at the premium cost before Obamacare in the individual market, and then after Obamacare on the exchanges. Second, we will get a state perspective, a very important state perspective. In fact, our second and third guests flew into Washington at this time, and it's quite a challenge to get into this crazy city, and so we're trying to acclimate them to how things happen and don't happen here in Washington. But we'll get a good state perspective from James Mills. Mr. Mills is the Assistant General Counsel for the Oklahoma Insurance Commission. Commissioner Doak, who was supposed to be here, ran into bad weather and could not make it this morning. Fortunately, Mr. Mills came in ahead of time. So he's a graduate of both a law school and an MBA program, both in Oklahoma. And he works with Commissioner Doak on a broad range of issues with an emphasis on health insurance. He works with regulators around the nation with the National Association of Insurance Commissioners. And he also works very much with folks across the country on high-risk pools, and particularly Oklahoma's high-risk pool. As you know, the Affordable Care Act changed things. Before it, individual states did the regulation of insurance products for their state. After Obamacare, now there's a much greater federal presence, which is defining the dimensions of a lot of the health insurance products. Mr. Mills will describe how that is playing out in Oklahoma. And finally, we will hear a very frontline perspective, a consumer perspective, from Larry Patterson. He's a small businessman from Texas. And since starting his company in 2003, he did something that set him apart from many small business owners. He decided from the very beginning to offer his employees health insurance. He's one of 36% of small businesses who offer coverage. Now, ironically, that coverage is threatened by the Affordable Care Act. So Mr. Patterson will talk about how the Obamacare has affected insurance and the notices he's just received from Blue Cross Blue Shield in Texas on his plan, the choices that face him and his employees, and what he's thinking about doing. So first, we're going to have Drew present on the findings. Second, we'll get that state perspective. And third, Larry Patterson will give his story, and then we'll take some questions from the audience. Drew?
Hello and welcome again to the Heritage Foundation. I'd like to take just a quick moment to thank everyone for attending today and all of our viewers online, however many of them there are. Together today, we have nearly matched the enrollment in the ACA exchanges for the state of Vermont. And while this talk is predominantly about what sort of premiums one would expect to pay on the exchanges, let's get a little context on what enrollment really has looked like. The Congressional Budget Office estimates that around 7 million people will enroll in the exchanges in the first year. This means that in order for the exchanges to reach this target, 270,000 people have to enroll each week. As of yesterday, I didn't wake up and check today, I'm sorry. It is roughly estimated that about 50,000 people had enrolled in the exchanges. This means that the exchange enrollment has been roughly 10% of what was expected. At the current rate, it would take nearly 50 years to enroll the 30 million projected to be enrolled within the next 5. While the numbers so far have been pretty uncertain, we have to note that, especially in the federal exchanges, we're just not seeing the numbers, and we should get to see them maybe in November. So, this sort of information has really warranted labeling the launch of the exchanges as a disaster, even by some of the greatest card-carrying members of the ACA fan base, such as Ezra Klein. The real question, though, still remains, what does it actually look like in terms of premiums on the exchanges? My research examines the price for people choosing to shop on the exchange and how this compares to what could have been found on the individual market previously. For most states, premiums are higher compared to what is available in the private market. For example, in the state of Oklahoma, my analysis finds that, on average, premiums increased by 60% for 27-year-olds, 22% for 50-year-olds, and around 6 to 10% for families of 4. In the state of Texas, increases are even greater. Premiums double for 27-year-olds, increased by 90% for 50-year-olds, and are right around 10 to 20% for families of 4. And this isn't just a couple cherry-picked examples. This is the experience for most of the states, actually 45 of them. States like Arizona, Arkansas, and Vermont are hit the hardest. For 27-year-olds, increases in Arizona are 160%. In Arkansas, 175%. In Vermont, premiums also increased by 144%. There are many reasons for increases in premiums, but one of the main drivers is something referred to as community rating. These laws limit flexibility in calculating premiums for a given risk pool. In the case of the Affordable Care Act, premiums are allowed to be adjusted by age within an age band, but not other factors. All states have an age band currently, or pre-ACA, had an age band compression of 5 to 1. This means that premiums can't be 5 times higher for an older enrollee compared to a younger enrollee. The ACA lowers this ratio to 3 to 1. This limitation leads to direct cost subsidization, or lower cost individuals paying more for premiums to mitigate costs for higher cost enrollees. My findings confirm this. 27-year-olds, typically lower cost insurance purchasers, see their rates increase by a far greater percentage, almost double the amount that increases for the older age groups. This effect, though, has even deeper implications for the exchanges. If low-cost individuals are encouraged to pay the penalty or not participate in the exchanges due to high premiums or other associated costs, the risk pool could be dominated by higher-cost enrollees, and this could lead to even further increases in premiums. This is often referred to as a premium spiral. If you need examples of the negative effects of community rating, you don't have to look very far. Some readers may be surprised to find that our projections for premiums are decreases within the states of New York and New Jersey. These are two examples of markets that tried community rating and guaranteed issue in the 90s and completely disrupted their individual insurance markets. Markets that have been subjected to regulation similar to the Affordable Care Act will not have the same experience as other states. When or if more people are enrolled into the exchanges, the real question will be what kind of people are in the exchanges. If only high-risk individuals are signing up currently, this means that insurance premiums will increase. We have to remember that we are still looking at very early stages of understanding what enrollment will look like in the exchanges. The administration won't even release the numbers until November. So right now we're still speculating on 36 states and what their enrollment distributions even look like. Hopefully, when the administration finally decides to release the official numbers, the picture will become a little more clear. However, with the data we have, it is putting it mildly to say the Obamacare exchanges are in for troubling times. Even if the federal exchange website and many of the state websites are glitch-free soon, this doesn't change the fact that many individuals, when they manage to get the shot to purchase health insurance, will be met with increases in premiums. Thank you.
Thank you all for being here today. Thank you for viewing on the internet. And Laura, thank you for hosting this panel and having me as a participant. I'm excited to give you a look into what life is like in Oklahoma, thanks to the Affordable Care Act, and when it trickles down across the country, what we really see when it comes to a life that's different. My name is James Mills, and I am a native Oklahoman. I was born and raised in the city where my father grew up also. Despite my mom's best attempts to get him to cross the border down into Texas and have me born as a Texan. So I might be a little more in Larry's shoes if she'd gotten her way, but I've lived my entire life in the state of Oklahoma. I went to school there, I was educated, and went to law school and also got my MBA there at the University of Oklahoma. And so I'm very familiar with the issues that affect Oklahomans and the differences in lifestyle when it comes to maybe what you wouldn't expect to see when you come to Oklahoma. Oklahoma is kind of a moderately sized state. We have 77 counties and a population of 3.8 million people. We're not a particularly rich state. When it comes to average household income, it falls in right about $42,000 a year. But we do have a lower cost of living because we do have a lot of land and we're able to keep prices down. We're also a transportation hub for the country. We have an intersection of a number of important interstate highways, and that gives us the ability to bring things in at a reduced cost. So the income matches up with the costs of Oklahomans there. Approximately 30% of our population would fall into the 400% and above level of federal poverty income levels, which is applicable to things that I'll come back to. And while I'm on that note, just over half of our population would fall into the 100 to 400% of federal poverty levels. We're also a state that's known for its Native American population. In total numbers, we are second in the country behind California for Native American population, and they comprise about 8.6% of our state's inhabitants. When it comes to the health insurance picture for Oklahoma, we're about what you would expect. We have a lot of employer-based health insurance for our people. We have 46% of our state is covered by some type of employer-sponsored or integrated plan. In comparison, we talk a lot about the individual mandate and the individual exchanges. Right now, 4% of Oklahomans are covered by an individual policy. On top of that, we have about 17% of our state is uninsured right now. So about 1 in 5 Oklahomans would be in a position most likely that they would be looking to the individual exchanges because they don't have the employer-sponsored, they don't have Medicare or Medicaid or another public plan to be in there. So when we look at the effects of the ACA on our whole market versus who it was trying to address, We're talking about an impact to the entire insurance system in Oklahoma, trying to address what 1 in 5 people actually have to deal with. But health insurance isn't anything if you can't buy something with it. Health insurance leads to health care. It gets you doctor services. It gets you the prescriptions you need. And in Oklahoma, there's a very high need for health care. Oklahoma is ranked 43rd overall in the nation by America's Health Rankings for 2012 when it comes to quality of life on the health outcomes side. But more importantly, we're ranked 49th in the nation when it comes to the accessibility of primary care physicians. We have a very rural state. We have 5 areas of rating that are based on the metropolitan statistical areas, which are our 2 largest cities, Oklahoma City and Tulsa. We have 2 others, one of which is actually Fort Smith, Arkansas, Oklahoma, because it's right on our border, and the 5th area would be our rurals. When it comes to the availability of primary care physicians, we have about 80 for every 100,000 in population. So there's a very drastic need not only for primary care physicians, but for primary care physicians that want to work in rural areas where the reimbursement may be low and their educational costs may be difficult to pay back. We have large universities with good medical schools, but many times once residency begins, these students leave the state and they don't come back. That's a challenge that our educational system is facing and that our legislature has to look at on how to bring these doctors back into Oklahoma and get them to serve their families and their communities where they grew up if they find more lucrative possibilities outside the state. To give you an idea on how the ruralness impacts us, though, according to the county health rankings from the Robert Wood Johnson Foundation, the range of primary care physicians per population is from 831 in the more populous urban counties up to 14,215 to 1. So quite clearly, there are areas of Oklahoma where, regardless of what your ability to pay is, you're going to have difficulty getting the treatment you need from a primary care physician. Oklahoma is a state that has a federally facilitated exchange. There's no participation at the state level in administering that, which means that from the regulatory side, our insurers are forced to go through 2 different processes. One at the state level, because insurance is a state-regulated process, but also at the federal level to ensure that the new mandates of the ACA are complied with and integrated into the policies they sell. And as Drew pointed out, we're seeing a lot of increases in costs. It's not just through the mandated benefits that are required to be a qualified health plan, but it's also things like age compression that increases the costs for some and lowers it for others. For unlimited lifetime benefits, so there's no more ceiling on how much an insurer may have to pay for the medical expenses of one person. Community rating, which is a concern for a state like Oklahoma when you see how poor our health outcomes are. There are a lot of people who are in good health and are going to have to be paying more because they're being lumped into their peers in a state that is ranked at the bottom of the nation. In addition to this, we have 2 state high-risk pools to try to address some of the needs of our most risky citizens. One is a state high-risk pool that's operated at the state level and has been for a very long time, well before the ACA. We also have a state-managed pre-existing condition insurance pool, which is managed by the same board but runs on the federal program that was a part of the ACA. This is a board that's outside the insurance department, but that we work with closely to ensure that there's availability for Oklahomans to have the health care resources they need when they're in a high-risk situation. There's a number of things that our state has done also. We do have mandates at the state level for health insurance, and we've compared those across the nation. And we're very in line with what is standard from state to state. We're probably below average when it comes to the number of mandates we have, and the mandates in that range consist of things like the treatments that have to be covered and the people that have to be able to receive it and the providers that you have to be able to have access to. And we're very consistent when it comes to comparing what we have in our state to other states. Virtually all of our mandates are accepted in probably 75 to 80%, if not more, of the states around the nation. As I've mentioned slightly, the National Association of Insurance Commissioners is a body that organizes the state regulators in every state. And it's a group we participate in heavily to make sure that Oklahoma provides the best insurance regulation that we can to our citizens. We've worked with them on a number of issues, and there's a lot of consistency between the states due to this involvement. One area that we've worked with the NAIC on is by being a member of a working group that's entitled the Regulatory Alternatives Working Group. It's a way for states who are looking for their own options, their own way to help their citizens increase their availability of health care, to come up with ideas and work both with the law and with creating our own ideas, creating our own opportunities to serve our citizens. As I said, we can provide a lot of dollars, whether it's through tax credit subsidies at the federal level to the citizens of the state, but if there aren't providers to accept those payments, it doesn't help our state any. But it does increase the cost for everybody, which is going to reduce the availability of care. It also increases the regulatory burdens on providers and makes it more difficult for them to grow with a complexity of the law that is expanding and putting more demand on their resources and their dollars too, to have the appropriate treatments provided under the new diverse health insurance policies that'll be available to people who may not know how it works and how to best process that in the future. Along with working with our state high-risk pools, our Attorney General has been very active in the federal arena trying to deal with the ACA's implementation in Oklahoma. We were not one of the parties to the large lawsuit that was focused on the individual mandate, and as such we do have a lawsuit outstanding based on the tax credit subsidies that are provided and whether it's an appropriate interpretation of the law to provide them in states with a federally facilitated exchange. The argument being that the law specifically states that these tax credit subsidies are available to state-based exchanges as a carrot on a stick to bring states in line and have them create their own. However, we see that over half the country has a state exchange that is run completely or in partnership with the federal government. And if these tax credits are not appropriate, not only does that mean that the citizens of these states will feel the full impact of the increases in the rates without the offsetting subsidies that the federal government intends to provide, but also that employers will not be subject to any penalties that are triggered by an employee receiving a tax credit subsidy. And as such, it creates a lot of confusion and uncertainty until this issue is resolved, and we hope that as it stands, it will be pushed through the courts and an answer will be given so that employers like Larry are able to have the answers they need to make the right choices for their businesses and for their employees. Oklahoma also had a plan called Insure Oklahoma that has been under a lot of stress under recent days and has been granted a waiver by the federal government, but has for a long time been thought to be closing. Insure Oklahoma is an Oklahoma-based health insurance plan that provides opportunities for both individual and employer-sponsored policies. It serves over 30,000 Oklahomans, and due to changes because of the ACA, thousands of these people are going to have to lose this coverage because of requirements to get it in conformity with the federal dollars that it received in association with the tobacco settlement trust dollars that were used to fund the plan and the premiums associated with the payments from the individuals that had it. It's an opportunity where Oklahoma had innovated and had provided health care that fit the state, and unfortunately a lot of people are going to lose that due to the ACA. I want to take just a minute and talk about some of the premiums that we see in the state. Early on, we spoke with our carriers before all the filings were settled so that we could get an idea of what would be going on in our state rate-wise. Our expectation was that rates would be going up 30% to 100% in the individual market, and I think Drew's analysis confirms that it falls very squarely in that when you average the rates out. As a couple of case studies, an adult age 27 before Obamacare would be paying $135 a month, and after Obamacare, $213 a month for a comparable plan as best as we could put them together. That's an increase of 58%. An adult age 50, due to things like guaranteed issue, age compression, would have a policy before the ACA went into effect of $298 a month. We're seeing that go up to $363 a month, which is another 22% increase. And I want to give you an example that our office has worked with recently. We had an individual who's a male, 57 years old, who called our consumer assistance team trying to find out what his options would be for health insurance and get a little help. He was on COBRA, but it was going to be expiring at the end of the month. We were able to assist him with looking at the plans that were available now and the plans that would be available through the marketplace. Right now, he's going to be going from his COBRA to a plan with a $2,500 deductible, 80/20 coinsurance, and he'll be paying $335 a month with no pre-existing conditions. When the beginning of the year starts, he's going to have to move up to a $3,000 deductible to keep that 80/20 coinsurance, and his premiums are going to go up to $420 a month. It's an increase of $85 a month for this individual that he's going to have to pay. In addition, we're seeing a lot of plans that are just not as favorable for Oklahomans being filed and put through the exchanges. We're seeing a lot of plans that are filed with $5,000 and $6,000 deductibles. We're also seeing networks shrink. In fact, our HMOs are not going to serve large portions of the southeast, southwest, and northwest Oklahoma because of the ruralness of it and their requirements to put in appropriate network adequacy. So we have 5 insurers that are putting plans through the exchange, 2 of which are HMOs and will not be available to a large majority of our geographic regions. Another issue that we've seen in Oklahoma is how the impact is going to affect our large employers, one of which is Hobby Lobby. This may be a company you're familiar with, but it's founded in 1972 by David Green, an Oklahoman, and it's headquartered in Oklahoma City. It's a company that has 21,000 employees in 561 stores around the country. However, they're also run in conjunction with Mardell stores, and these stores have always operated under Christian beliefs of the ownership. The owners have closed the stores on Sundays despite losing out on massive revenue to do so, to give their employees the ability to go to church. They've also offered health insurance to all of their employees in a very beneficial plan. However, because of their religious beliefs, they didn't want to provide abortifacient drugs that would be post-conception. It's out of line with their religious beliefs. Their injunction to be exempt based on these religious beliefs was initially denied, despite a number of their contemporaries in other states being granted injunctions until this can be determined. Fortunately, this was appealed and this was reversed on appeal, and Hobby Lobby is currently continuing to fight this court case. The U.S. has appealed to the Supreme Court, and if the Supreme Court takes it up, hopefully we'll see a decision on it by the end of the 2014 year. In addition, we have a number of Christian colleges who have filed lawsuits, including Oklahoma Wesleyan, Southern Nazarene, Oklahoma Baptist, and Mid-American Christian, who want to be able to provide health insurance and health care that falls in line with the Christian educational institutions that they run. And we support their ongoing efforts in trying to find the right fit for Oklahoma. I think the most important thing for Oklahoma, though, is that we're putting a lot of effort that's affecting a lot of people without thinking about the impact on Oklahoma as a state. Every state has unique needs and differences that are part of why state insurance regulation exists. It's not done at a federal level, it's done by the states, because every state's market is very different, and it's something that whether it's health insurance or it's the catastrophes that states face, or if it's the workers' compensation laws and many of the other areas that we deal in, it's difficult for a one-approach-fits-all type of law to go through and be impactful and beneficial for the members of those states. We hope that as the law progresses and goes forward, that Congress can create opportunities for states to take back the regulation that they've done for so many years to provide the best options for their citizens, not only in the way that helps the health insurance, but provides the health care that insurance buys. Thank you all.
So I guess y'all missed my note about queuing up the theme music for Dallas as I was coming up. And James, I just wanted to mention there was a little football game down in Dallas a couple days ago.
Boomer Center.
Yeah. Well, I'm a Mustang. Been stuck in Dallas now for quite a while, and I love it. But that's a fun game to watch every year. You never know who's going to win. Thank you to Heritage for hosting this and having me up from Dallas. And also want to thank my insurance agent, Matt Robertson, with Danes Insurance, who's compiled a lot of information for us over the course of the last couple of weeks. My name is Larry Patterson. I'm the president of Glass Doctor of North Texas. I represent 30 employees that we have in Dallas. We're a full-service glass shop that does everything from replacing your windshield to putting in a shower door to, well, all kinds of it. You just think glass, and that's what we do. You can imagine our base of employees is a healthy mix. We've got half of them are our specialists that work out in the field, and then we've got everything from salespeople to administrative people in the office. Since inception in 2003, I made the decision to offer health insurance to our employees. I've always felt that it's the right thing to do, and also, if you want to attract the best, you have to have good, strong benefits. We've offered an HSA and a PPO plan since inception. Until 2010, before many of the early provisions of the Affordable Care Act kicked in, our HSA plan was offered to our employees at no cost. In fact, we actually, in addition to offering it to them at no cost, we actually contributed money into their health savings account in addition to that. So as a result, everyone was covered. If they chose to buy up to the PPO plan, they had that available to them also. In our 2011 renewal year, after the early provisions of the Affordable Care Act kicked in, our rates went up significantly, just over 20%. We only have so much money to pay to provide health insurance. One of the arguments I've heard is, well, why don't you just raise prices? Well, that in a competitive market, that doesn't work. So we ended up having to create an employee contribution to our HSA plan. We were no longer able to contribute money into our employees' HSA accounts. I'm sure some of y'all can predict what the logical outcomes of those kind of actions are, but as we progressed, we saw people start to drop coverage because now it was costing them money out of their check every week. We also saw people that, as we hired in, we have as I see here, a lot of young faces. We have a lot of young people that work within our business, and people were coming in and looking at the rates that they were going to have to pay and saying, here's my income level, here's what I can afford, and I don't really see why I should be spending a couple $1,000s a year for coverage that I don't really think that I'm going to need. In addition, what we've seen is this the 26-year-old coverage. So if you're on your parents' plan, you can stay on it until you're 26 years old. Well, we've seen that a number of our employees still have that parental coverage, which in a lot of ways you say, well, that's great. There's a lot of positive aspects of that. But when you look at group health insurance coverage such as ours, all it's done is skewed our average age up of our group. So now our average age is much higher, which means higher rates for everyone that's left in the group. And eventually you do turn 27, and you have to get off your parents' plan and pay that extra. Let's see. Another trend that we've seen is a decrease every year in the number of employees that cover a spouse or a child. Initially, the increase in cost of spousal coverage or family coverage was unbelievable increase, and every year we've had people that have had to drop it because it's such a significant portion of their weekly paycheck. So we're looking at a problem of whatever you believe the number is, 45 million uninsured in the country. That's part of the reason why is people can't afford coverage for their dependents. So currently, as I said, we have 30 employees. We have 15 that are covered. We have 5 that are awaiting enrollment. We have 4 that are on their parents' coverage. And you look at that, that's a significant percentage of our overall plan. We have 1 with military coverage that doesn't need ours, and we have 5 employees that have opted out entirely, even though our HSA contribution is $20 a week. $20 a week. But when you look at that and you think that, these are real people. These guys work hard. And when you're looking at, they're going to have to spend, an hour or more a week of their wages to pay for something that they think is too expensive and that they don't need, they choose not to pick it up. A lot of these guys, they don't spend more than $1,000 a year on any type of health services. So why do they want to spend over $1,000 a year to pay for premium to have a $3,000 deductible? You start to get the math there. So, and one other key point is I find this irony of ironies. Having carried health insurance since inception, there is one little piece of paper that was not submitted to our insurance carrier in 2011 by a former agent that we had, which means that we don't have grandfather status for our plan. I find that ironic. I find it angering, frustrating. I can think of a whole lot of words that we don't say here at Heritage. But it's amazing to me that this one piece of paper, this one oversight for someone who's tried to do the right thing for 10 years has such a negative impact. Now everybody can say, well, dummy, you should have sent it in. Well, you know what? I had one of the largest insurance agencies in the country that was our agent that neglected to turn in this one piece of paper. So what are our choices? As I said, charge more. How do y'all like that? Yeah, okay, didn't like that. As I look out personally, my family coverage cost, I just look at, hey, what's it going to do to me? Almost doubles. Now get this, guys. Premium cost for me, $17,800 a year with a $3,500 deductible. Wow. Anybody want to help out with that? Because I don't get a subsidy. So we can charge more. Our options as presented by Blue Cross Blue Shield of Texas. We can renew in 2014. Our plan expires February 1st, so that's our renewal date. We have an option to renew with Blue Cross Blue Shield for only a 73% premium increase. 73%. Unbelievable. We can renew before the end of the year. We can renew in December. The increase is a mere 23%. Now, okay, that sounds a little more doable. But when you compound that with the fact that our insurance costs have gone up a lot since 2010, the increase is somewhere around 200% when you kick into what the 2014 premium will be. How many increases can we sustain? And even if I renew in December, I'm looking at, well, all I'm doing is jumping a year ahead. When I go to December of next year, I know that additional 50% of increase is going to be there. As business people, we have to plan. We have to put together budgets. We have this little thing called profit that if we don't earn it, we can't grow, we can't pay debt service, we can't hire new employees, we can't stay in business. And we have to be able to project these things out, what our costs are going to be, what we can afford to charge in the market, what we can afford to compensate our employees with. And right now, it's wholesale uncertainty as to what's going to happen a year from now. Our other option is to drop group coverage. And that makes me mad. Because of the provisions of the ACA, after 10 years of offering group coverage to our employees, most likely our best option for our employees is going to be to drop coverage. That makes me mad. Because if we keep a group plan, a lot of our employees, particularly younger people, that might be eligible for a federal subsidy on the exchange aren't allowed to go out to the exchange and gain that federal subsidy. So we have to look at the numbers of what's the cost to everyone in our organization and say, well, overall, our average premium will be significantly less for everyone if we drop coverage and put them out onto the exchange. Once again, that's an angering thing. So what we're going to do is looking forward, what will we do? We're going to do what's best for our employees and for our customers. But I would like to say that, looking back, what this has done over the course of the last few years is a lot of uncertainty. And guys, I'm not the only one. Business owner after business owner that I talk to is just like me. We don't know what's going to happen next year. Therefore, that money that I might have available to invest and grow my business, I don't know if it's going to provide me a return on investment or not, so what am I going to do? I'm going to keep it. Now, we hear about large corporations that have huge cash balances that they're just sitting on, not deploying, not investing. That applies to small business too. The uncertainty has affected our growth in the past and hiring new employees. You look out and we've had one of the lowest prime rates in history for the last 5 years. Our country's growth should be off the charts right now. Where is it? Giving a businessman 3.25% prime rate is like free money. People should be taking it and going and investing it in their businesses and growing at an exponential rate, but we're not. Why not? Because it's only free money if I can make money with it. And there's a lot of uncertainty around that ability. So not investing, not growing, and looking forward, how do these changes affect our ability to recruit and retain the best employees? How is this going to affect my customers? And this is a bigger question. How is it going to affect my customers' ability to spend money? Because if I'm seeing these kind of increases, what's everybody else going to see, and how is that going to affect their disposable income? Our commercial accounts, same thing. What are they going to cut? They're going to cut capital expenditures. They're going to cut maintenance. They're going to defer those things as their costs go up because they have to make profit also. So what we have and I'll speak specifically to our business, is we're in a holding pattern. What's going to happen? Just tell me. Help me figure it out so that I can make good decisions and move forward. But once again, we're still stuck. What do I do? If we could just answer that question, for the majority of businesses in the United States, we would see a great improvement in our economy. But we don't know what to do. And I say this, we can cue the theme music from Dallas again. I say all this as a businessman in what is perhaps not perhaps, it is one of the best performing local economies in the entire United States. What are guys like me saying in areas that are still suffering? Dallas is growing. Dallas is vibrant, but still, it's a scary place to invest when you don't know what's going to happen next year. Thank you.
Very good. Like I said, 3 very different perspectives, but all with common themes and a common message. I was really struck with Larry's story that he had a system where all of his employees, it was a win-win. Everybody had the opportunity to have coverage. He paid for a portion of it. Now he's looking at a situation where there's going to be winners and losers, just about with any decision he makes. And that's not the intent of the Affordable Care Act. So I'd like to open it up for questions and see what you all would like to ask of our guests. Just say your name and what affiliation you have, please.
Hi, my name is Matt Brockmeyer. I'm with the States Alliance for Balanced Insurance Regulation. This question is for James. First, I want to thank you for Commissioner Doak and yourself for your work on behalf of Oklahoma and basically for the rest of the states that are kind of trying to push back against the Affordable Care Act and the regulations. But aside from the lawsuit you mentioned and your state's refusal to expand Medicaid, which I think was the right thing to do. Going forward, what's the role for state insurance regulators for Oklahoma and for the rest of the country?
Thank you for your question. State regulation is still very important, and it's something that's well adhered to by the states, and we expect to continue as it does indefinitely. As you're aware, there's a federal insurance office, but it's very clearly denied the ability to regulate insurance by statute. Usually Congress likes to make things permissive, say what agencies can do. They don't go into the business of telling them exactly what not to, but in this case, we're fortunate that they don't regulate insurance, and that's very clear. The NAIC works to ensure that we have best practices so that the consistency that insurers need between states, as well as durational consistency into the future, where they're able to know that the laws, the way they are now, and the regulation is going to be expanded and grown into what is best for consumers to ensure that the insurers can pay the claims that they're required to do, but also benefits consumers in ways that products are easy to understand and easy to purchase. Our commitments in our state as well as around the country. Our department has focused on a number of initiatives, and Commissioner Doak has been very active in his opposition to Obamacare coming into the state. And it's something our state has clearly pushed back on. We've had state questions to add constitutional referendums just to try to say that we don't want this, regardless of how it all plays out. We have issued a bulletin in recent months that addressed the issue of navigators, for example. It's not just the insurers we regulate, but the people who provide the insurance. The licensed agents and brokers that sell it to consumers are an integral part of the system, and we support them wholeheartedly. And we go into background checks, we go through educational licensing activities, as well as continuing education to ensure that as new things arise, like the Affordable Care Act, that they're well versed on how to operate in the market. Our department has offered a number of classes to agents and brokers on how the ACA works and how to find their role and the way the law works now. And so that's something that's important to us. We also issued a bulletin on the idea of navigators versus licensed producers to show what a licensed producer can do in the state and what other people can do as a kind of a clerical and an assistance duty. But if they want to move into the area of recommending how and which and how much to spend on health insurance, that they need to get a producer's license and work with the insurance department in Oklahoma.
Yes.
Ben Stovall, I'm an intern here at Heritage. Actually, a follow-up to that question as well, for you, Mr. Mills. You mentioned how the states will continue to be safe legislating, and that power won't be taken away by the federal branch. But my question to you would be then, with how blatantly this administration has been ignoring the states in pretty much any regard of it, this particular legislation, all the way down to just the exchanges being taken out of the states' hands and put in the federal hands if the states decide to opt out. Are there any safeguards put in place other than that one aspect of how it's set up to begin with that might be disregarded at some point? Are there any other safeguards put in place or any avenues that the administration could take to get around those? And if so, what can we do to stop them from doing so?
Thank you. I want to say that we know that this law is overreaching, intrusive. It goes and makes people do things they don't want to do, that don't make sense for them to do. It takes good decisions and makes them make bad ones instead, when it's not that they don't have health insurance because they don't want it. It's because of logical reasons that they've gone through. This is something that's important to people and they all care about, but at the end of the day, it's the health care they want. It's not the health insurance. And whether they pay that out of pocket or if they have to pay a premium to have somebody else tell them to pay it out of pocket for a while so that they can then get it paid for, that's a decision that individuals should be able to make. Now, when it comes to dealing with the administration on this as a state regulator, we work with CCIO and somewhat the other agencies, OPM, for example. Kathleen Sabilas is a former state insurance regulator. Teresa Miller at CCIO is someone we work closely with, and it was also a former state insurance regulator for the state of Oregon. So I think there are some people in the administration at that level that the states are able to work with and that do understand what it means to be a state regulator and the benefit of that in the entire process. And so individuals like Teresa Miller, although we may have differences of opinion on what the law should be, we're both in positions where we are regulators, not legislators, and we do our best to work together and to figure out what's going to ultimately serve the consumers that are purchasing health insurance. I think moving forward, it's important that people like this that have state insurance regulation are involved in the process. Director Huff from the state of Missouri represents us at a federal level to show the state view, but he's a non-voting member. And it's a challenge to get state rights heard when we're looking at things from the Washington, D.C. perspective. It's important for legislators to understand that when it comes to health insurance, the health care availability and needs of every state are going to be unique, and that they need to get back to the state and talk to their insurance departments, talk to their commissioners, and let them be as involved in the process as possible, because it is something that is regulated across the nation. It's just not done on a national level. And we work together very well through entities like the NAIC, and we want to make our availability to Congress, to the administration, well known, so that we can continue to have conversations and figure out what's going to be best for the states as they move forward.
Yes, down there.
Milton Grenfell, thinking about predictability, this 7,500 pages and counting, trying to tell people what to do in this Affordable Care Act. Is it ever going to settle down? It seems like it's just going to keep generating more and more in complexity. It'll change, keep changing, and it's the hopelessness of trying to centrally plan individuals' lives in something as complicated as this. So what's your hope of this settling down? I mean, what's going to be the outcome for you? Do you think ideally, how would this play out?
Gosh, it's almost like you have to throw ideals out the window at this point. Yeah, I mean, I think about, like reading an Ayn Rand novel and how long and complex it is, and how many times I fell asleep while reading it, and then I think of a 7,500-page law to tell me how to buy insurance. It's insane. Yes, from a business perspective, we've politicized now something that has been an integral part of the business community for, gosh, longer than I've been alive now, employer-provided health insurance. So from an employer's perspective, yeah, it's very real to look out and say, what's going to happen from one year to the next? Gosh, we can't even, in this town, we can't even tell you what's going to happen today or tomorrow. Are we going to pay our debt? So how the heck are we going to, how am I going to project out what's going to happen with health insurance? What I fully expect is that this is going to be a political football for the rest of my life, unless and I hold out hope that the law is repealed at some point. Shout out to our great senator from the state of Texas. Thank you. But how does it? But every election cycle, what's going to change? And that throws a big wrench in the works for the business community. So yeah, the ideal hope is at some point everybody, realistically, what's most likely going to happen is the people that think this is the greatest idea since sliced bread are going to start seeing real numbers. It's one thing to talk about it in an abstract sense. It's another thing to sit there and say, hey, guess what? Your premiums went up $352 a month. And you got that? You got an extra $352 for it because that's what you're going to have to pay. Or guess what? You get a penalty because we think that's a great way to we think coercion is a great way to get people to do things. If the plan was, if the law was that great, people would be signing up for it voluntarily in droves. That's a market-based approach, though. Forgive me. So ideally, hopefully the law is repealed, but most likely it's just going to be tossed back and forth. And what does that do to a guy like me that's trying to predict out 2 years, 3 years, 5 years in the future? I mean, realistically, and I'll give you a great example. I have a good friend of mine who has a large manufacturing business in Mesquite, Texas. It's a little suburb of Dallas there. He is the largest manufacturer in the world for small high-temperature kilns. It's a small niche business. He employs about 80 people there. His cost alone, once the employer mandate kicks in, is going to be in excess of $250,000 a year. Yeah, I mean, what does that do for, I can't move my guys to Mexico, to China, to whatever, so I'm one of those guys who's just got to live with it. But, yeah, I mean, why not? Why not just, move your manufacturing business, overseas? It's just one more reason. And that's what I think people don't get is, guys like me have to make long-term decisions to invest capital so that we have employment, we have tax revenue. Last time I checked, the government doesn't create any of its own tax revenue. Well, they print money, but that's a whole nother issue. We'll leave that alone. And we're stuck with not knowing what's going to happen in perpetuity. Great position to be in. I hope that answered your question. Sorry, I jumped around a little bit there.
Sure, we've got two questions down here.
Randy Randall. First, Larry, you may want to run for Congress so that you can get that sweetheart 72% subsidy.
I don't think I want to have to bathe that often.
I understand.
But thank you.
Yes. Look, the issue that we really have to confront is cost, and premium is only the starting point because you can hide cost in premiums with deductibles, and copays. Has anybody done the analysis to tell us what really happens at the end of the year when you add up all your real costs, premiums plus deductibles that you eat, copays that you eat? Who's doing that work?
I can answer this. We're starting to do that work. That's my next project in the works. But I think you probably have some perspective, especially on the deductible.
Right, I can speak to it generally. You're absolutely right. What we're seeing as far as a filing standpoint, and this is just general, we haven't crunched numbers on this, but we see deductibles for these plans going up because they want to offer low-cost bronze plans. So to get that cost down for the monthly premium, the deductible goes up. What we're also seeing is reduced networks because if they can reduce the network size, then they can tell the providers, hey, you're going to get more volume in business, so we can take a little bit less and pay you less for it, but you're going to make it up because you're going to get more people.
And that, from a business perspective, that's called insanity. Yeah, it doesn't work.
But
Doesn't work.
I know a lot of
Make it up
providers
on
that
volume.
just want to be providers, but there's a limit to how many people they can see, and when you pass that limit, either they can't see people or the quality of care is going to suffer. So we need to figure out how to compensate based on quality of care when it comes down to that. People need to be getting treatment for their dollars. They need to be getting health care and positive results for their dollars, and figuring out how to do that is important. But also, we know that in rural Oklahoma, we have a lot of hospitals that just are on the brink. We worry about hospitals closing in Oklahoma. With these large deductibles, one of the big concerns is that hospitals think they're going to get more uncompensated care. Now it'll be by people who are insured, but because they have a $5,000 or $6,000 deductible, as high as they can essentially make it, but keep it under the out-of-pocket maximum requirements, they're afraid they'll never see that 5 or 6. And for things that are elective surgeries or for not emergent or urgent hospital stays, they want to get that money up front. And that's the discussions that some of the hospitals are having to have is how do we make people pay up front these big deductibles to make sure we get the money and we're not out that additional cost. Seeing how that plays out will be difficult.
I think that in addition to the cost question, also quality of care becomes an issue also. Recent experiences I can think of, but how many people actually go to their doctor and actually get to spend more than like 15 minutes actually with the doctor?
That's a lot.
Yeah. But I can speak a little bit from experience. The state of Texas, you are allowed to request your loss numbers on a group plan. And every year we've done that, I keep looking at it and going, why don't we just self-insure? Because our losses are insignificant compared to the premiums that we're paying. And of course, my agent keeps saying, yeah, but, and I get it. And self-insuring wouldn't be a good decision, but we don't spend a whole lot. We don't cost Blue Cross Blue Shield a lot of money on our plan. They do quite well. And of course, that helps to cover, their costs elsewhere. But I think the much bigger question is what's going to happen. I can see the outcome of this. This is kind of a side, but part of our business is auto glass. and auto glass has been covered for years by your auto insurance. And as auto insurance companies have built insurance companies have built networks, they've driven down the price of auto glass to the point where guys like me are saying, I don't want to service insurance customers anymore. Here's your bill. You deal with your insurance company. Well, most of the doctors I know, and they deserve it, they work hard and they've done a lot for their education. They probably make more money than I do in most cases. I fully expect that you're going to see that dynamic change because there's going to be doctors that just they don't want to deal with, $60 for an office visit and have to run you in and out. And you're going to have consumers that demand or have an expectation of greater service than that 15-minute doctor visit is going to allow for. So, I mean, I think logically we can see where this leads long term. So it's not, the cost issue is definitely important, but, you take out the quality of service from that because the outcome's only going to be as good as the quality of service. And we're talking about people's health, that's a pretty significant consideration also.
And one final question over here.
My name is Lewis Phillips. I'm an intern here at the Heritage Foundation. This question is for Drew. What can you tell us about the 5 states or 5 or 6 states that will not have increased premiums? Do you know why they were able to do that and why the other 45s were not?
So the states that don't have increases in premiums, generally it has to do a lot with their previous regulations. As I mentioned, New York is the prime example of this. If you're already regulated to a point that looks and smells a little bit like the ACA, when you actually adapt to the ACA, you're not adapting so much, and so the markets just look drastically different than a lot of the rest of the country. There's a couple states that are a little more confusing, and this has to do also. There's another big question about what insurers within the state expect their distributions to look like in the exchanges. So if your expectation is that you're not going to have a lot of adverse selection, meaning more sick enrolling than healthy, you're not going to price your premiums as high. There may be a little bit of that going on, but a lot of what's driving the cheaper expenses or cheaper premiums in the states has to do with previous regulation regimes.
And I can speak to that also. My daughter, when she was at university, not to be named, in Colorado, which is one of the states on this list. Don't want to get anybody in trouble. This was pre-ACA. She was older and couldn't stay covered under our policy. We got her an individual policy. Luckily, she still had residency in the state of Texas because when we looked at the individual insurance cost in Texas versus Colorado, it was double the cost to insure her individually in Colorado.
Well, I'm sure you'll join me in thanking our guests. They have had a great dialogue on the very real impact in real lives, real states, as well as a great production on numbers quickly after these exchanges opened. So thank you very much for sharing.